Dan Ives describes what we should be watching out for in 2026. Check this out.
I'm wondering how you would characterize the current tech market landscape. And with a couple weeks left in the year, Dan, how well have your predictions for 2025 held up?
Look, I'd say it's been a robust year, relative to, I think, the view of tech and what we've seen in terms of tech stocks. And I think the AI revolution, right, in terms of the monetization, ultimately the build out and the CapEx, and what I view as almost a CapEx super cycle. I think if I had to characterize like sentiment, look, obviously it's like there's nervousness out there, right? Like, is it a too big to fail moment? Is it an AI bubble? So every time something happens, there's definitely some nervousness. But look, and I think you could see with my ETF, in terms of the performance, look, obviously it's been a great year, but I don't view it as kind of like in the past. My focus continues to be like identifying the AI winners, understand tech, just staying one step ahead. Tech bull market, 2 more years left.
When we look at the names we affectionately refer to as the Mag 7 or the Magnificent 7, Dan Ives, don't look now. Only 2 of them are outperforming the S&P 500. Google up 65%, NVIDIA up 34%. Our mutual pal Jay Woods wondered to me earlier this week, is the Mag 7 now a bit of the Lag 7? Are you surprised at the underperformance from most of those names?
Yeah, look, I view it a little differently because I view it as like, look, the AI revolution is being led by Mag 7. I mean, CapEx, you're going to have what, 600 billion of CapEx next year, in terms of, ultimately as that plays out. I think the story is, even though those names significantly outperformed over the last few years, it's the second, third, fourth derivatives that are really outperforming in tech this year. But I don't view that as a bad thing. Like, I think next year you could see maybe Mag 7 outperform, in terms of some of those names. But it speaks to my view, this bull market is going to spread across small, mid caps and outside just traditional big tech.
Dan, I remember asking you, it's got to be at least 2 years ago. It's a while ago. If you had to add one name to the Mag 7 to make it the Elite 8, at the time, you told me AMD. You were pretty bullish on what Lisa Su was doing with regards to leadership of AMD. Would that still be your thesis? And I wonder, do you kind of view the tranche of companies a little bit differently, with some you would remove and maybe some new ones you might consider adding?
No, I'd say, look, AMD, Palantir, right? And maybe Broadcom. I mean, those are kind of the names that you'd like, not just in terms of like what players they are, but just how important they are to the AI trade. But I think when you start to think about, like, let's say in software, MongoDB, Snowflake, you look in cybersecurity, CrowdStrike, Palo Alto. I mean, that's like my whole Ives AI 30, right? Like, it's all about, it's not just about 7 names, trying to identify like the second, third, fourth derivatives across tech. Because as me and you've talked over the years, like, this is a true fourth industrial revolution that's really playing out.
I think Dan might be right. We may be seeing a genuine AI-driven cycle where not just mega cap firms, but a wider swath of tech companies benefit, if not all companies. Companies are investing in AI with more discipline, many are already profitable, and CapEx is much more targeted, reducing some of the risks that lead to crashes in fragile cycles. Think of it like a wave that started with the biggest surfboards, the mega cap tech firms. Those companies, the ones most people know, rode the big first swell in AI investments. Building cloud infrastructure, buying hardware, deploying their AI services, that gave them big gains. Now, Dan's idea is that the wave is spreading. Smaller and mid-sized firms like semiconductor suppliers, specialist AI software makers, service-orientated tech companies are getting pushed by the same sea. Because the infrastructure has been built out and because demand is broadening, those firms don't need to win the AI race alone, they just need to plug in and deliver value. This reduces concentration risk. If only a handful of giant firms benefit, valuations get stretched and fragile, like what happened in the dot-com bubble. But if the benefits spread across dozens of firms, hardware makers, software tools, cloud service providers, specialist AI service firms, then the whole industry becomes more resilient. Growth becomes more distributed. That means opportunities for investors outside just the big familiar names. Additionally, some companies in this broader slice are already profitable. In past bubbles, many firms were burning cash, hoping future values would justify current prices. This time, because of better demand visibility and clear AI use cases, companies are building real, sustainable businesses. Spending is already locked into budgets. Big cloud companies, governments, and enterprises have already committed to multi-year build plans. That means even if stocks get volatile, the real-world spending continues in the background. Factories still run, chips still ship, data centers still get built, and this also explains why Nvidia, Broadcom, AMD, and the networking names have been so strong. They sit directly in the supply pipelines of this build-out. They're the ones selling the shovels in this digital gold rush. As long as the infrastructure build continues, demand for their products doesn't disappear overnight. With expectations for interest rate cuts in 2026, valuations start to look more reasonable again. Lower rates tend to benefit growth stocks because debt servicing gets cheaper and future profits are discounted less harshly. That could support a broader rally even beyond the big ones we've all heard about in 2025. So there's a plausible setup. If infrastructure demand, capital discipline, and macro conditions align, it could spread gains across the tech sector into a more sustainable way than past cycles. Now, once that infrastructure gets built, the market doesn't stop, it actually spreads wider. The market is shifting from the first wave of AI leaders into the second, third, and fourth layers of companies that will benefit from AI. Money is now rotating into companies that run on top of the AI stack, not just the ones that build the stack. Think of the AI cycle like building a city. The first companies to win are the ones that sell concrete, steel, and power. That's your chip makers and cloud giants. That was phase 1. Phase 2 starts when buildings go up inside that city. That's software companies, cybersecurity firms, data platforms, AI tools, enterprise apps, and automation systems. These companies don't build the infrastructure, they use it to create products that people actually touch at work. This is actually healthier for the market. When only 7 stocks go up, the rally is fragile. When 50 or 100 different tech names start moving, the bull market becomes harder to break. It becomes more stable because money is spread across many business models instead of concentrated in a few giants. It also changes the risk profile. Software companies, cybersecurity firms, and data platforms scale faster than hardware. They don't need factories, they don't need massive inventories, their earnings can grow much faster once customers are on board. That's why these phases often produce the biggest upside moves after the infrastructure phase is already underway. This is why Dan lists names like Palantir, AMD, Broadcom, CrowdStrike, and Palo Alto. These firms live either at the edge of infrastructure or deep inside enterprise AI usage. What we are seeing now is rotation. Early leaders take a breath while new leaders catch up. That's exactly what long bull markets look like when they stay healthy. A lot of people want to understand AI properly, but feel overwhelmed by the jargon. I created a structured course that explains the fundamentals in simple language and then moves into more advanced topics. Once you join, you get lifetime access to all current and future modules. Just to note, the price increases as new modules are added. So this is the cheapest the course will ever be. The link's in the description below. Picture this, a potential client searches for what your business offers and your YouTube video appears. Before they've even booked a call, they've built trust with you, turning them into a warm lead. That's why our clients are hitting $100,000 months, because YouTube turns attention into authority. If you run a business, book a call and I'll show you exactly how to make this happen.